Happy Monday. Welcome to the final hour. It's 3 p.m. Eastern Time, March 31st. Give me a quick wire yes if everything's coming through loud and clear. We are on youtube.com/Chris Pulver, youtube.com/Financial Wars. We are on X. We are on Facebook. We are on LinkedIn. So just put together this thumbnail. Q1, we're right back down to the lows. We had a little bit of a rally off those lows. We'll take a look. I did mitigate some risk today on NDX, ended up taking a loss. Had some winners, closed out SPX, staying above 55.10. Max profit would have been about 170 bucks, closed out for about $120 today per contract. So all in all, fine. Still hanging on to some nice gains. So even though we are at fresh lows, I'm still hanging on to six figures plus profits for the year. And that is fine and very workable, despite being mostly red for the day, still, very green on the year. And we're sitting, at these lows. So let's discuss. Also, before we are done with today's final hour session, I will be going through a series that I'm running this month. Kicks off on Thursday, and this is basically how I protect my portfolio. I'm running a masterclass called Crash Insurance, and we'll start this Thursday, 4 p.m. Eastern Time, and then for the next 3 Thursdays after that, we're live trading every week in the month of April. And this is essentially 20 years plus of my trading into a course that is helping you protect your favorite positions, always have downside protection, lower your cost basis, calculating what you have for a break even on your stocks, and also take very high reward to risk asymmetric hedges to help mitigate a lot of the drawdowns that we may see in the markets. So I'm just going to briefly go through the current markets and just get a top down for today. We're trading at 19,204 on the NDX. My break even on the day was 19,275. And based on the options chain right now, NDX option chain for today, 19,275 is still quite a bit difficult to get to. Now we could have a 57-minute rally that goes nothing but up, but if we don't get to 19,275, I would not be at break even. So I did end up taking a smaller loss. I saved myself. I'm trying to think how many positions I closed. 1, 2, 3, 4. Double check that. 1, 2, 3, 4, 5, 6, 7, 8. Wow. So I've got 8 times 2,500 would be my max risk. So 20 grand, I end up closing for about minus 10. So all in all, I save myself about 10 grand in risk on NDX. The only way that's going to be angering to me is if we all of a sudden get up to 19,275 in the next 56 minutes. Then I guess I'd be break even and I would have to lose $0. But at the end of the day, I'm still profitable elsewhere. Like I said, still having some nice gains on the year, and off we go. So, okay. So just a quick top down, I'm looking at a couple things here technically. Markets today, we just revisited the lows. This is the end of the quarter. I've been talking about this for several weeks now. The key level to close above today on SPX was 55.65. I had all sorts of gamma flows today. We're trading at 55.47 or 55.95. 55.65 was the key level. You can see this giant level today that we had some hedge flows here. Wasn't surprising, but we are coming back into like the largest level. Now, the reason I said 55.65 is that is essentially a Q1 pin from one of JP Morgan's biggest fund positions. So what I'm curious of is when we open up the quarter, or they're probably doing it today, a 20 delta for Q2 is potentially acting as a major support zone and resistance area on the SPX going into Q2. So I'll take a quick peek of that. This is something you can write down going out to June 30th, where we end the quarter. So June 30th on SPX, looking out to let's look at the put side first. That's really more what I'm after. Is the put side is sitting anywhere between around 51.80. I'm actually going to write this down right along with you. So 51.80. So this would be a JPM Q2. So 51.80 and potentially down to like 5100. Well, I guess if I'm pinning it towards the 20 delta, probably 51.80 to 51.50 on the downside. And on the upside, let's go up to the calls. And 20 delta calls, probably around 59.90. 59.90, I think 6,000 is a round number for there. So as far as support resistance for the next quarter, write those down. 51.80, 59.90, and plus or minus about 10 to 20 points. I'll try to verify that in the next few weeks if I can find those big pin gamma levels. But that's what I'm watching for. And also on the downside, just because we don't know how ugly and nasty this market may get, NDX, you better not get to 19,275 today. I'll be so annoyed. Anyway, to the downside, this is really key structure here on the downside. Okay, and that key structure is right here. So we had our little flush. We're back down to the lows. We revisited that with a big nasty slide Wednesday, Thursday, Friday last week, and we ended the quarter fighting back a little bit today. 55.96. You know, the S&P turned positive. The Nasdaq is turning. It's reducing a lot of the risk today. So we're at 19,209 for the NDX. Qs are down 0.35%, still red. The Dow's had a pretty good day overall. I believe the Dow's outperforming all. So the Dow's up 0.83%. Russell is down as well. So Russell is down. Dow is up quite a bit today. Also price weighted, not market cap weighted, which certainly helps. Nasdaq still red, and S&P coming back from the nasty lows we opened up at. So the reason I had this larger yellow box to the downside is I mentioned that 51.80 zone. This morning when I looked at the 20 delta puts out to the end of the quarter at end of Q2, it was around 51.20. So I boxed this in. This is a 618 fib. In addition to any type of overshoot that gets us into previous resistance to become future support. So I'm just like I don't think this is going to be perfect. But from all-time highs, if we drop down to this level, that's about a 16.5% correction from high to low. That's still like deep correction territory, but that's reasonable for, okay, maybe that's where the market starts to pick up a little bit of bottoms if we even go that far. I think right now, depending on what we do for the next couple of weeks, I mean, we have Trump tariffs that'll be announced and maybe a little bit more clarity for the market this week on the 2nd of April. And then we have I'd say a pretty telling look at the labor market with non-farm payroll on Friday. So I wouldn't be surprised technically if this flush down is going to have some type of flat pattern, which means we're going to come back and revisit the same recent high that we have here. Okay. So for the next 1 or 2 weeks, I would say if this market is up and then it's just kind of drifting back up towards these 5,700 levels, 5870, 5750 levels, this sets up for a potential bear flag. Okay, let's say we come back up here, we flag, which means that the bears continue to defend this area here, right? The bulls have a lot of work to do to prove that earnings, the economy, is still just humming along and chugging along as it needs to be justifying these type of highs. If it is not priced in, and this is one thing with more tariff clarity this week, if it's not priced in, this is open space that I think the market gets a lot worse. The bottom is not in. I keep telling traders, this whole idea of a Trump put or Fed put is not at these lows. I'm sorry to say that, but the Fed is not going to react and make some emergency cuts just because we had a 10% sell-off. Anytime the Fed comes in with emergency backstop measures and quantitative easing, to some degree, it's probably a 20+% correction. In fact, I even looked on AI today. I use Grok, which is X's AI. They have Grok 3 that got released. I looked at the top 10% quarterly declines in the S&P, and this is nowhere on the map. We're not even close. 1931, 33.8% quarter to the downside. 1932, 24.9%. 2009, 22.6%. 2020, 20%. January to March, Q1 down 20%. 2008, 19.4. That was Q4. If we look at 1932, we're not even talking like modern markets here. So, 2009, 20+% quarter. 2020, 20+% quarter. 2008, 19.4% quarter. You go to 1987, October to December, 17.5. That was mostly that Black Monday. 2001 dot-com bubble, 14.7, 1970, 14%. So a little tiny 10% correction. Like I said, not the floor. I don't think this is the floor. I think if we're fortunate to de-risk once again, I've been harping on this for the last month or so. This decline, given the market a little upside, de-risk, de-leverage, take some nibbles in short-term positions for maybe a 1 or 2, 3 week window, which is exactly what I did. And I was telling traders to do the same. We had some really good profits. We closed out a ton of winners in that area. But watching this, I want to make sure that if we had the opportunity to do that again, I would still be de-risking, de-leveraging, just in case this market wants to then start to roll over. The technical break, in my opinion, is below this 5,500 zone. If we break 5,500, things get a lot worse. Okay. And this could still be a high, low, lower, high. We could have a flag pattern here, but we could still go lower, low. And that type of move could still be faded one more time for a 5-wave move. 1, 2, 3, 4, 5. And then we'd be talking about bottoms for longer term positioning. All right. So it's 5,500 key support. Okay. Very strong economic breakdowns. Is there something wrong? No, that's what I'm saying is like everyone's worried about like, oh, the Fed, they're going to step in. It's like, no, they don't. They don't and they shouldn't. Because if they do step in, I think that the biggest barometer for how this economy is going to go is this 10-year yield. Because the only way this 10-year yield came off these recent highs is because the market fell. So look, I don't think the market is broken. Everyone thinks that we have stagflation. Everyone thinks we're worried about risk. We don't. Stagflation requires high inflation, slowing growth, and high unemployment. We don't have high unemployment. Recession requires tons of job losses. We don't have that. So the economy is still resilient. Earnings are still forecasted to be decent and positive. Now, they could be revised lower. There could be some earnings compression there, but that's what this first quarter is showing us. Things are being relocated, right? Reallocated. Mag 7 needed to correct. It happens. That makes sense? So, no, I don't think that all the things I mentioned, like that 20, 25, it's like something was breaking. I don't think right now the market is breaking. I think there's still a resiliency in this market. You piece of crap. NDX at 250. Man, what a turd. I'm sitting here watching this thing. There's no way. Sure enough, 255. I'm still not at break even, but I'm just curious. I just got to check and then we'll get into a little pitch here. So, um, yeah, I would have saved myself another like maybe $500 or $600. So, again, I'm still going to watch. Here is the 19,250. If it gets into 19,275, this is my break even. If it was above 19,300, that's really going to piss me off because that would be a $2,500 winner that ended up taking about $1,000 loss today. But again, it's possible we could still have just a rip, but something tells me probably not. Probably not. 19,300. If it's above that, that's a $2,500 winner plus the profit trap and the credit. That'd be about a $2,600 winner that I let slip, but it's not there yet, and it'll make me feel a little bit better if it stays below 19.3 today. Okay. Anyway, give me 1 second. I have my 3-month-old kid sitting on a coffee table in his jumper. Let me make sure he doesn't fall over. So give me 30 seconds. I'll be right back. And when we return, let's talk this. Okay. This is a class, like I said, masterclass series I'm running through this entire month. We're doing it every Thursday, and I'll jump into this in about 30 seconds. Give me 30 seconds. I'll be right back. Okay. We're good, good, good. Yes. Okay. Sounds good. Hey, Thomas, how are you? We're all good? All good? Okay, good. Got Christian here, got Thomas, got Dean, Dipsium, got Realize. Okay. So here we go. This is, for the last 15 plus years of managing accounts, the most important thing I can do is protect the downside. My job as a trader is to make the most amount of money I can, the safest way that I can with the least amount of risk. It is not easy. I'm obviously sacrificing some upside, but I do pretty well. I typically beat the benchmarks. I compare myself to the S&P a lot, which I know some people say that's impossible to do or stupid to do. You should just buy the index, whatever. Because of options, I am an active trader, and I usually outperform. So, point is, if I'm going to make 20% a year, I also want my drawdowns to be as minimal as possible. And an example, I'll go through the charts here in just a moment, but I've just been using this to kind of explain the method of my madness, just as an example. So here is a recent to take another tranche at a better price. Not necessarily, Pete. I mean, I put it in today based on what I liked. So plus it's above resistance levels. You're talking about the SPX one. I'm fine with that trade as is. I mean, you're down 30 cents, man. I'm not that worried about that trade. The other trade that we put in earlier for the bull put spread should actually be showing some profit. So, all right, here we go. Here's a little summary of this year so far. I showed about 195K in my portfolio earlier in the year. Okay, so we had our December fallout. We got back to these highs. I was taking some nibbles during December, but I had some hedges going into the end of the year and into Q1. Okay, so this is what the class is all about. This is what the Master Series is all about. I was up about 195K. Now, obviously, I was dealing with a bit of a drawdown, but I have hedges in here that paid me around $30,000 to help mitigate some of that risk. So although I was seeing open positions that were fluctuating lower, mechanically, they were still closing out for a lot of profits, and I closed out a ton of winners on that little 2-week bounce right there. Okay, now mark this 195K right here. Okay, when this market went up for just a couple of weeks, that little tiny pullback, I was up 205K. So I was down in the market. The market's still 6, 7, 8% lower than it was at these all-time highs, and I'm sitting at new highs for my year. How's that possible? Well, because I'm hedging and also actively trading through all of this. And I think that is the most important thing. So even if this market were to go down 10%, let's say with my hedges, which is this Crash Insurance Masterclass, let's say that my drawdown is only 5%. And there, when I keep biting and taking some chances to then make some money income-wise, I can generate, 1 to 3% gains here, just as an example. And essentially, there's not a lot of drawdown that I get affected by. And through that correction and this little correction, and even through the end of the year, I mean, it lined up where it was a really nice Q1 hedge, and I didn't really get into a lot of trouble. I'm still up a decent chunk of profit this year. I'm still up around 4% for my portfolio, even though the market is still down from the all-time highs. Market is still down about 8.76%, and I'm actually positive about 4% for the year. So that's a 12 to 13% performance improvement by me versus the market, which I'm happy to take. And obviously, I hope that continues. Now, if this gets worse, high, low, a little flag pattern, and then this thing breaks major support and goes lower, I want a hedge out to the end of Q2 or the end of Q3 or the end of Q4. And this is what the Masterclass series is all about. Because if we go lower, I want to make sure that I have some really big asymmetry, which means my reward, is way bigger than my risk. And I put these trades on for about 0.25% risk to about 0.5% maximum risk that usually offer up about 1% or 2% minimum gains. Minimum. And sometimes I can get as much as 3 to 5% on some of these positions. And if I stack these up, if I have a little bit more conviction, I line them up in different instruments. Like I could basically hedge on the NASDAQ, hedge on the S&P, hedge in futures. I can hedge on ETFs. I might line up where I'm taking a total risk of about 0.5%,
And a lot of times I can line up a winner that's going to be 3, 4, 5% in gains, which helps alleviate those chunks we get to the downside. If the market is falling 10% and I've got 5% of gains, that certainly helps me battle the market back. And I'm not taking on all that risk. Does that make sense? Okay. So that's what this is all about. So that being said, I'll go into this right here and let's walk through it. You have any questions? Let me know. I see the chat running, so you can type in your questions. But of course, we're wondering like, where do we go next? This market testing the lows and still finishing off the lows today, it does offer up a short-term opportunity to again de-risk. I think if Trump's April 2nd tariff deadline and his discussion, maybe the market can finally make some sense, heads or tails, of what is this tariff situation going to be. Is it a flat 20% tariff for everybody? Is it a 20 to 25% tariff? Is it across the board? Is it certain countries, certain partners, certain frenemies? Are we having fluctuating scales? I don't know. This is what April 2nd is supposed to be about. Also, this week on Friday, we are kicking off officially Q2 tomorrow, and we have a non-farm payroll event on Friday. So the market's also going to be digesting, how about U.S. jobs? Are we losing jobs? Everyone's talking stagflation, recession. You don't get either one of those without having a lot of job losses. So unless non-farm is a monster whiff and unemployment claims this week is way higher and initial jobless claims is way higher, we are not in data-driven recession territory, okay? But that doesn't mean that Trump and company can't cause more pain. That doesn't mean that if they want the 10-year to go lower, if Doge is going to try to cut $1 trillion out of the budget this year and out of the deficit, that this market can't be repricing earnings and repricing valuations. And that's probably the next leg lower, is if earnings are not up to these valuation levels and the consumer is not willing to buy what everyone is charging for and what everyone's passing on these tariffs for, that's the slowdown. Consumers cut back, companies can't pass on the tariffs, and earnings are revised lower. That's the next big question mark. That's the next shoe to drop. Does that make sense? Okay. So that being said, what we're going to talk about here is a way for insuring your accounts against market corrections. This is a powerful way to guard against these 5-10% drops that we see in the market. If it drops further, you're still protected. It's even a little bit better in case the market drops, but obviously it doesn't happen very often. We don't see 10% swings all in one direction. Usually, if the market's down peak to trough 10%, could come in a 3, 4, 5% dip and then a rally, then a dip again, or we have like a slide of 10, rally back up 3, 4, 5%, another slide of 10 to 15. Then we're talking capitulation, whatever. So point is, this is like insurance, 0.25% of my account, maybe up to 0.5%. I usually do this when premiums are very low, not high. But in the event that we are going to go lower, I'm buying a little bit more time, creating some really simple option trades that anybody can take. Since April of last year, just using a really near-term example, 14 of these hedge trades, I had 9 of them that were winners, and I still have 5 of them that are still open. The average winner was over 100%, 150% on average return. And like any system, this is not foolproof. If this market goes higher and these bulls are in control, I will lose on these hedges. But I'm willing to sacrifice. If I did a quarterly hedge as an example and I sacrifice 0.25% of my account, I'm risking 1% total for the year. And I could be dead wrong. Well, that's fine, because if I can risk 1%, but I can have 15, 20, 30, 40, 50% upside, I don't care. I'll risk the 1% all day, every day, right? Now, there's going to be winners and losers. Not every hedge is going to be perfect. We don't time this market reasonably well. It's difficult too, but if I give myself like a 90-day window, 120, 150-day window, half a year, a full year, pretty sure I can get a window that looks technically sound, right? So not every trade is going to be a winner. I can't guarantee any specific future results. I, of course, don't have a crystal ball. There's always a high degree of risk in trading. So if you have any questions on that, we have terms, conditions on our Prosperity Pub homepage. This is why I work with traders. I'm looking at a way to give folks an edge. I manage capital. I'm looking to make the most amount of money I can with the safest amount of risk, the least amount of drawdown. It's that simple. If your emotions are winning the game or the battle in trading, then you're probably trading too big. Change it. Trade smaller. This can be a wild roller coaster for a lot of traders. When you have real money on the line and real emotions on the line, it can get a bit messy. I like to keep a clear head. I like to stay objective, and I'll pick and choose my battles as I do through anything. All right, so I'm glad everyone's here. If you're following me out there on YouTube and you're watching this live session, you know me. This is an account hack I've discovered, probably one of the best things I've done in my last 25 years of trading, which is knowing that I can fight these markets and protect myself against these big downturns that do happen. Sometimes they're fast, sometimes they're not. This year was like the 6th fastest decline that we've seen in the market ever. So I thought that was interesting. downturns like we're still dealing with because we retested those lows from March 13th. We tested it again to open up today much lower. This is where the markets are showing us are the most vulnerable. It's those weekend levels that if something wild happens over the weekend, this market can definitely gap higher, lower, and be pretty disruptive. It gapped higher when we had that Sunday to Monday with the rip higher, and it gapped lower over 1% today when the market retested these lows. Now, this helps me avoid a majority of losses. Just being on the hook for watching the market drop 10%, my account would be down, all of 10%, or individual stocks being down 10, 20, 30, 40%. That's what makes things challenging, right? Most traders get wiped out. Most traders are over leveraged and overextended, don't have enough cash to buy anything. And what I'm talking about is I'm just looking to get protection. It's not that difficult. Okay. Not that difficult. So these insurance payouts do really, really well. There's 160% on MES, 120% and 121% on MES. Just the one instrument I hedged on MES, ES, SPY, and QQQ for this first quarter, and those paid out really, really well. And the market's obviously dumped, pretty hard for about 3 weeks. Now, I'm not saying this to brag. I'm saying this because this is what I do. This is what I have to do. I know the market's not going to go up all the time, so I'm trying to open everyone's eyes to realize there are trades we can take to protect our accounts. And if I can spare a 0.25% risk, I'll sacrifice that for the greater good of the markets going higher, which is what inherently the market's going to try to do. We may not be at the bottoms yet. This market's going to ultimately try to go higher. If you look further out, let's say 1, 2, 3, 5 years out, this market's probably going to be at all-time highs again. The S&P is trading around 5,500. It's not unreasonable to think that we're going to get to 10,000. Okay? So if you stay the course longer term, we're going to get there. But how long does it take? How long does it take to go double your money from here? I don't know. Maybe it takes 3-5 years. Maybe it takes 10 years. I intend to trade it all the way for all the ups and downs. Okay. All right. So it acts as a retirement shield. You can start with just a tiny fraction. This is defined risk in all the trading accounts. For this little move to the downside, it was nice to have some gains, which also lets me know that even when the markets are down, I have trades that are working for me, right? And so a lot of traders don't insure themselves. They don't have that protection. They tie up way too much capital. They're holding and hoping that everything comes back. And even in raging bull markets, we still have downturns. Okay. This is crazy stuff. 3 times a year on average, we see at least a 5% pullback. Okay. 10% or so, we have about every year, or 1.6 years, we have a 10+% correction. 15%, now we're getting into like the 2 to 4 year window, and then 20% or more every 4 to 6 years. So corrections will happen, right? 100% of the time for the last century, we've at least had a 1% correction. So the market is going to pull back. It will have pullbacks. And these crashes will happen typically when greed is at the highest. So we see the market running. We typically see overbought conditions. We see divergence. We haven't had a pullback in months and months and months. And then we get a correction, right? Market sees as an opportunity to buy the dip. And what happens? More greed, more rally, making new highs. Momentum is good. Are we in a healthy environment? What's the economy? What's the business cycle? But same thing, another crash, right? Another correction. But is the same thing over and over again? Yes, it's like this market stretches and breaks and stretches and breaks and stretches and breaks. The last real break we had was 2022. That was a persistent downtrend for about 9 months before it bottomed out. And then before that was 2020, before that 2018, before that was 2016, before that was 2012, before that was 2008, 2009, before that 2000, 2001, 1998, we had a 20+% correction as well. That's 27 years of trading that between 10 to 20%, they do happen. And so I want to be protecting, right? I want to be protecting my portfolio. Like I said, I don't have to be spot on with the timing of this, but within a 3 to 6 month window, I'm going to get paid on some hedges with some high reward to risk. And if I don't get paid, I'm assuming the market is steady and stable and going higher, and those hedges are fine. I'll just sacrifice that little bit and we make gains in a bull market like we should. Okay. So I don't want anybody to feel like this little dip we had for the last 3-4 weeks and visiting these lows again. You're sitting here like back in trouble. Everything's red. You're struggling. You're don't beat yourself up. It's not easy to do this. Okay. But if you're not insuring your accounts against these pullbacks, it's going to be difficult. And that can wipe out a lot of traders, make them lose confidence. And worse yet is it's amazing how many traders run to cash or just want they want the bleeding and the pain and the frustration to stop. And so they just quit trading, right? They close out losers because they don't want the pain to get worse, or they hang on to losers and watch their account go to essentially massive drawdowns because they need to wait it out. And then they have nothing to buy. They can't actively trade through anything. and you just hope that the market pulls back. That's not a strategy, in my opinion. I want to be actively navigating the downside. I want to be protecting my portfolio downside. On the way up, it should be pretty easy to still chip away, take some nibbles, and trade actively through any type of upswings. Okay. So, we just had that little 2 week pop and it's faded right back down to the lows again. And like I said, that 5,500 level is a key support zone. If it breaks, no joke, we can head back down to these August lows of 2024, April lows of 2024. And if we just keep swinging for those lows and we start clawing back at those support levels, the next level is like 5,000. That is a huge technical level and a big round number. That's going to be around a 17 to 20% correction in the S&P. That to me would not surprise me to get there this year. If things go bad, that's where it could be. But it'd have to be bad. We'd have to have like a liquidity air pocket. We'd have to have the Fed basically say we're not cutting rates, and the Trump administration and Doge would continue to be pedal to the metal on tariffs and basically pissing off the world with trade relationships. If that happens and earnings are revised lower and consumers cut back, that's the perfect storm of things falling. So it can certainly happen. Now, I imagine that nobody wants to go through the pain and you never want to feel it. You want to have something working in your favor if the market's going down, right? So this is why I take account insurance really seriously. I've been in the market since 2000. I've traded obviously all this stuff, dot-com bubble, 2008 great financial crisis, the great reset in 2022, COVID. Not to mention all the flash crashes I've seen in currency trading for the last 15 years. I never really thought about insuring my accounts until after the great financial crisis. I was pretty, even having 5, 6, 7 years of passive investing under my belt since 10,000 or 2000, I didn't know how to use options and insure my account. But since then, and certainly since managing money, it's a big difference in making sure that I can, confidently say my job is to make the most amount of money I can, the safest way I know how, with the least amount of risk. The upside, the profits that's easy. That's the easy part of this game. It's the protecting the downside that separates the professionals and the people that survive these markets from those that don't. And that's me. I've been in this market for a long time. So I realize I have to have insurance and have ways to, confidently tell my clients, hey, we're okay. Here's why. In fact, on Saturday, I did a video sent out to all my clients. We are, $90,000 to $100,000 better off than where we were last week or 2 weeks ago, which is good. And I feel like I'm properly braced for potentially more downside, but also taking stabs and nibbles at these lows. Okay, so I dug into the research. I hate the fact that Lehman Brothers is in here, but it was part of the research and the Fed. But 0.25% of your account against these 5 and 10% drawdowns, which happen, 2 to 3 times a year, happens every 1 to 1.5 years. We've got to be ready for that type of stuff. These are the dips that traders should love, but most traders panic and they end up missing these bottoms, missing these opportunities, because when it happens, the news is so bad, the outlets are so noisy, and it seems like it's just going to keep falling. We fall 10%. Well, why can't it fall 15? Why can't it fall 20? That's what it feels like all the time, right? Remember last summer, July to August, everyone was talking about this is the crash. The JPY is going to get deleveraged. The BOJ is going to deleverage. This thing's crashing. We got all these, these extreme leverage ETFs. This market's dropping 30 to 50%. That was all in the news, right? The Fed saw the SOM rule activate with unemployment, and all of a sudden the Fed makes an emergency measure. The market's going to do the exact opposite. Again, blah blah blah, bad risk. It's just an awful position. Awful. Market went up to all-time highs many more times for the year before we got to December. Okay, so point is, having triple-digit returns feels pretty good, especially with a tiny little risk. Okay, and so you stack those up, like I said, every 3 months, every 6 months, half a year, once a year. It's not that challenging to do it. It's a very simple trade. I'm going to walk you all through it this week on Thursday and the following Thursdays we can trade. So as the market collapses, I'm actually making some money, and it certainly helps mitigate a lot of that drawdown. It's no different than buying insurance, okay? You got a car, you got a house, you got a boat, you got your health, your medical coverage, right? Everybody has something that they're paying insurance for. Everybody. And do you like it? I don't, right? Do I like buying insurance? No, I think it's a scam, but you have to have it. It's a mandate. If you get into a car accident with no insurance, good luck buying another car. Or good luck not having it. Next time it's like, well, I'll get insurance next time. It's like, good luck. It doesn't work that way. So, we're paying a couple $100 a month for something that is probably unlikely that'll happen, right? Like, it's unlikely that we get in a car accident. But if it does happen, we're certainly glad that we have some insurance where you'd think, well, at least my car's covered and maybe my insurance goes a little bit. But point is, This is a tiny little cost. Tiny little cost. So for a couple $100 a month, that can insure me against my entire car getting hit, or my boat sinking, or my house catching on fire, or getting some type of natural disaster, which that's another thing about insurance. Why is it a scam right now? Because people that have had natural disasters over these last 3, 4, 5 years are having it harder and harder to get their possessions replaced and their homes replaced. I don't think that's fair at all. But it's crazy. Like, oh, you live in a fire hazard area, we're not going to insure you. You live in a, hurricane area, we're not going to insure you. Like, that's crazy. But they're going to ask you to pay it, and they're going to want you to pay it. But the point is, if you're willing to insure your car, your house, your possessions, your health, why wouldn't you be willing to insure your trading account, right? For something that is guaranteed to happen once, if not multiple times a year. And if it gets worse, obviously for a 20 plus percent pullback in the markets, that insurance is going to pay really, really handily, right? That comes in handy. So put another way, if you knew, or you were guaranteed to get in even a minor car crash, if you knew that your house was going to catch on fire every single year, wouldn't you pay for the best insurance possible? Yes, of course. So same thing here with your accounts. For a very cheap cost, you can understand how to protect your portfolio all year long and help fight the downside if and when it happens. Here's April 2024. What did I see? Overextended on the 200 moving average. Relative strength was peppered here at the highs. We saw overbought conditions with divergence. And we also had a rip from essentially November, December, January, February, March, like 5 or 6 months in a row without a pullback. So what did I do? I had insurance out to the end of April, insurance out to May. And what did it do? Warning signs were there. Market did correct. 5% plus correction in the S&P, 6% in the NASDAQ, 10 plus percent Bitcoin. Bonds were down almost double digits. Correction, it paid really nicely. Okay. And also, as it's falling, I'm seeing the increase in volatility. I'm selling more premium. I'm actively trading my way through it. And then the market finds a low and goes back up to all-time highs. I fight the fight to the downside. I stay in, actively trade my way through it. And by the time we're back to all-time highs, I'm way ahead of just the buy and hold investors. Okay. So I had some crash insurance that paid nearly 300% when that market fell, right? So, 6 months later, we've got April, May, June, July, August. All of a sudden, what did we do? We had another big stretch to the upside, overbought conditions and some divergence. We're sitting here at these highs. We've got the concern of, oh, the Fed's going to cut rates, but what if they don't? What if they pause? So same thing. We got further and further away. We stretched to some fresh highs. I played a September game. A lot of times I tend to look at a seasonal hedge because April, September arguably are a seasonal dip in the market. So one of the worst times of the year. So I was hedged through it and I was protected. So the market dip, this was about a 10% correction from July to August. That peak to trough was about 10%. It was extremely disruptive in the futures market. We had another vulnerable weekend I think in 3 days of trading, the market was down 8% of the 10% correction. The Nikkei 225 was down 27% in about a 3-week period, and it was 17% in 3 days. Very fast, very disruptive. But if you were insured through just a seasonal trend of like August and September, you did pretty well. So I already had the crash insurance built in, and that tiny little percent paid pretty well. That 10% decline, 350% gain, 349%. It helped, right? And then we went up and we found a bottom on August and we traded our way through it actively. And by the time we get up to those highs, I'm well above that again, and off we go. So my account doesn't suffer with just the pain of a drawdown, right? So this is a good time to remind you that there's always risk of loss in these markets. And I know that if the market falls, I would rather have protection and peace of mind that knowing something is working in my favor. I can protect my favorite positions. I can protect my entire portfolio. And if the market goes up, everybody wins. It's the easiest market in the world. Everyone's called bull market geniuses. It doesn't look that hard when the market's always going up. This is the environment that separates traders and professionals from the dum-dums, the diamond hand, Wall Street bets, throwing everything they can at it, lost porn. It's like, oh man, I lost 100% of my account. It's like, that's nothing to brag about. I don't care if you started with $5,000. You're like, well, it's fine. It's $5,000. It's like, but what if it wasn't? What if you did the same type of trading style when you've got 50,000, 100,000? I don't want to lose that money. So risk of loss, I get it. Like I can sacrifice that 0.25%. But the point is, these trades are designed to protect you when the market goes down. If the market goes higher, totally fine. Easy to trade bull market, small losses, gladly accepting those small losses because we'll have other trades and we'll also have a lot of winning trades just based on the general direction of the market, right? So during unexpected downturns, not every trade works out. right? So I know that all my insurance isn't going to pay out necessarily. But if I have crash insurance built in, that's a 349% gain. That certainly helps alleviate some of the pain to the downside, especially when I can actively trade through it. So this helps offset, a chunk of your losses, maybe even all of your losses, depending on how we structure it. So this makes our accounts a little bit more bulletproof, which I really like. Okay, just a few weeks back, here's our 10% slide. There's my MES trade, MES trade, MES trade, all stacked up for some nice wins. That was over 300% gains in those positions, which helped me ride that to the near the bottoms. Okay, so this helped me alleviate a lot of the pain and drawdown by just offsetting some of that risk. So all I needed was that tiny little fraction to do what it does best and offer me asymmetry and high reward to risk, which is how I set them up. And that crash insurance helps me protect my accounts for recent downturns. Okay, so we are starting to see this all over again, right? We're back up on the 2 week rally. We came back to retest the lows today for the quarter. We are possibly coming back up to maybe set up for a bear flag, which means we might see the same highs again in the next couple of weeks. Maybe that's the case, maybe not. Like I said, key support, if we break down below it, that's probably not a good look for the market. But if we go sideways, the market gets a little bit more clarity on tariffs. We see that the labor numbers are not that bad. Then the U.S. would be okay, and there's resiliency there. Okay. But traders were shocked on Wednesday, Thursday, Friday how aggressive this market came, and then of course opening up today another 1% lower. We made fresh lows. So now our high to low sell off is in the 11+% zone, I believe, for the S&P, probably 14+% in the Nasdaq. And the markets, continue to sell off. So that was Friday. Like Friday all day, this market was just red. It came all the way down to like 55.50 or so. The SPY came down to 55 or 555 all day, and it just stayed there. And then we broke lower today. Okay. You shouldn't let the same cycle play out over and over and over again, knowing that these are going to be inevitable corrections without knowing how to protect your account. Okay. So the good news is this is a very straightforward strategy. It doesn't take a lot of time to learn it. It doesn't take a lot of time to get these key strategies and core strategies to protect your favorite positions, to protect your entire portfolio. That is what I do with it. Okay. So beginners with some basic options experience, just understanding, okay, I can do a bear put spread, which is I buy a put and sell a put. And I look at a high reward to risk, or some out of the money puts or some collar trades or anything that just enables me to take advantage of downward direction, right? Especially this downward direction in a low IV environment, it makes it even better because when IV grows and we're long anything and it's going in the right direction, we can make a lot of money. Okay, so here's what I'm going to teach you with this class. Again, this master class is Thursday, right? And I'll have the prices and everything. It's cheap. I'll just tell you right now, just give you a little sneak peek. It's $197. If you're interested, this is going to be a master series all this month, every Thursday, and you'll see how I'm hedging my entire portfolio, the warning signs to look for, what I'm watching for, the technicals I'm watching really closely, what market moving events and combinations could cause it. Again, this is a big question mark. I don't know what's going to cause it, but I do know whatever it does do technically when price is reflecting this crash, there's going to be a bunch of news events and headlines that read, "This is why," right? But it's all starting because of a rotation that was needed, way too much concentration, way too high valuations, and now we have market uncertainty, right? So it's all in this like giant like globe of all these things could be working together to create this perfect storm to make things worse. Or it's like, well, maybe tariffs are bad, but labor market is solid, so we don't have stagflation, we don't have recession, or like it could be one thing that doesn't do enough to rattle the entire markets, or it could be all of them and everything is bad, and we have this perfect storm of downside movement. But this is a nice way to keep your accounts nimble and agile when corrections do inevitably happen, and most importantly, building this crash insurance that corrects. When we get these 5, 10, maybe this year, like peak to trough, I could see, no joke, a 15 to 20% correction from the all-time highs. And that may still not be enough. I mean, honestly, that doesn't mean the bottom is in. I would say we have some protection there. We have some levels there. We have some bounces likely. But I mean, if 2022 with a monster deleveraging and raising rates was going into a 25 to 35% correction, I don't know why we can't do the same thing. Because for instance, 2022, we made multiple all-time highs. The market's up 70+%. And yet here we are talking about it again. So if there's a monster deleveraging, that could be very disruptive. So I'm looking at helping people crash proof their account. This is a 4-week workshop. It starts on Thursday. It's my crash insurance masterclass. Okay. This is the only place that I know of. This is where I'm teaching traders how to put in these crash insurance masterclass trades, retirement shield trades to protect your accounts all times through the year. It may not be perfect. It may not be getting paid every single hedge that I take, but when we need it, it is there, knowing that even if the markets are down, I have something that is going to show green in my account. And hopefully that green is far bigger than what the initial risk was. So here's how it works. This Thursday, we're going live at 4 p.m. Eastern Time for part 1 of this 4-part masterclass. I will talk to you through the core strategies, how I take these trades, what they look like, different ways to protect your entire portfolio, different ways to also protect your favorite stock positions. We'll cover the warning signs to look for, some of my favorite reliable technicals. What am I seeing in the markets, right? And how am I looking for tops and bottoms in the market? I'll share that all on Thursday. And that way you're never going to approach the markets year after year thinking like the market just has to go up, has to go up, has to go up for you to make money, right? This market does go up. Longer term, for nearly a century, it's found ways to go up and go higher and go higher. It probably will continue the same. I mean, if we have a rough year in 2025, give it time and it'll be back to 6,000. The S&P will get to 6,500. It'll be at 7,000. Give it time. It'll be at 10,000, but that could be years away. And I'm not trading that far out. If it's going to be like, if I knew it's going to be a decade away, well, what if I have to face a 50% drawdown before we start to really build back up to 10,000? I can make so much more money if the market is down 50%, because I know getting back to these all-time highs is 100% gain, and then another 100% on top of that, that's a 200% gain in my portfolio, right? So point is, I'm going to trade through this market up, down, sideways. And I know this market is very sensitive to the downside, and we could have another 5, 10, 15% dip, no problem. And so if that is the case, I want to make sure I'm getting paid on it. All right. So I'm not just going to stop here. I'll show you the exact trades I'm looking at. You can take them yourself. We can calculate them in. I'm looking at about a 0.25 to 0.5% risk in all these trades. So we've got the core strategy class this week and then live trading after that to finish out the month of April. And we'll reinforce all the techniques. We'll be live. All the sessions will be recorded, posted in your classroom, and we can trade live together. Okay. All right. Let's see what else. Recording every class. Yes. In your members area. Yes. So, and I'm live like this. I mean, doing it today in this YouTube session, doing it live every single day. Like I can reference it. Hey, I can go to my one-click trading member portal, sure that the recording is up and running. But this masterclass is enough for me to say, look, I'm taking 20 years of trading, and in a month masterclass series, there's no reason for us not to have tactical, knowledgeable protection in our accounts, right? It doesn't have to be a lot of risk. I would say if I'm right, once a year, it's enough to mitigate a lot of the risk. If the market's going to drop 10% and I can alleviate 3 to 5% of that, that makes my drawdown less. It allows me to trade through things and still come out ahead way, way faster than the market having to get all the way back to all-time highs. That makes sense? All right. So really important for the market. There's a ton of volatility and uncertainty that may get more clear as this all unfolds the next couple of weeks, which is fine. I still want to have hedges in. I still don't believe this market bottom is in. And we're talking about, sticky inflation. We still have this uncertainty with tariffs. What about the labor market? What about the Fed? What about monetary policy and fiscal policy? What about this fiscal cliff? All these things that we cannot control. What can we control? How we trade and how we allocate our risk, right? I'm not crazy bullish right now. Okay. I'm not also crazy bearish right now. I think it's a time to just take steps, take bites, trade the market, approach it every like 30 to 60 days. I actively trade through the day. I trade with a lot of members every single day. We trade every single day. Today we're 2 for 2. Even with a wildly crazy market today, we're 2 for 2. Okay. So what does April 2nd mean? Well, that's Liberation Day, whatever Trump's going to call it. We'll see what the market wants to price in. I care about what price does. If price goes higher, that is a classic buy the rumor, sell the news. Right? The rumor is tariffs. We don't know. It's going to get worse. The buy the rumor, sell the news is that now that it's here, the market's already priced it in. Boom, market goes back up. Maybe that's what we're dealing with this week. Okay, maybe not. But if you're trading with me live, we got all the stuff to navigate and talk through it. So special bonus, I've got a Liberation Day playbook that'll be right off of the price action from the S&P and all the markets this week. And then next week we'll start talking live. We'll get through the Trump tariffs. What does it all mean? But like I said, most important thing is watching price action. And we can trade it all together. Whether it's up or down, we'll trade it. This Crash Insurance Masterclass series, I want to trade. And most likely what I'm going to do is my first batch of trades that I talk about will be core strategy on protecting the portfolio. And most likely my expirations will be August and September. There's a seasonality to that. I think if I can get through August, September, if we have a downturn, it usually rhymes with what we see seasonality, which is a dip or pullback. But if the market just kind of stalls and goes sideways, I want to make sure I have enough time either through August, September, or even out to December to see if I can catch another big chunk to the downside. Okay, so we got the Retirement Shield kickoff class on Thursday. We got the live trading sessions after for every Thursday this week. We got the Liberation Day playbook. We'll talk about it this week, and of course the live sessions and the trades that I take. If I have to communicate with any members in this class, I will just send out an alert through your email, through SMS, and any trades I take that I'm not with you live, I'll make sure that you still have them. Okay. So, I mean, just think about the insurance side. I mean, if you have to pay by force $200 a month for your car, or $100 a month for your homeowner's insurance, or whatever it is, or your boat, or your motorcycle, or whatever, you pay for insurance that are things that shouldn't really happen, right? I'm paying for insurance that things happen all the time. They happen every year. The market is never straight up. The closest thing I've seen to straight up was 2017 when it was this crazy low volatility and the market was up a little bit every month for 12 straight months. Those hedges didn't work very well, right? But that's why at 0.25% risk over a year, I risk maybe 1 to 2% of my account while the market's up 15 to 20% all by its own. And all my positions are collecting income, making money, gaining on the upside. That's easy. So even though it was a weird market where the market never dropped and never really corrected more than 2-3%, the upside paid very, very well, and I could sacrifice that. But 2018, you had a great hedge in early 2018. You had a great hedge in 2019. You had a great hedge in 2020, a great hedge in 2022, a great hedge in 2023, great hedges in 2024, and even right now, great hedge going off this year. So most of the time when I put these windows in, they're going to get paid. Okay, so that's a good thing. So, how much is this class worth? Well, it's up to you. Do you want to protect your account and your portfolio? I think you do. I certainly do. And I know that if I'm down 10% in the markets, I don't want to be down 10% in my account. I want to be down way less than that. Okay. So if you had $5,000 invested and you're down 10%, that's going to suck. $20,000, you're down $2,000, that's going to suck. $50,000, $100,000, you can do the math. If you're down 10%, it's going to suck. That essentially means you are completely weighted to the market's ups and downs and ebbs and flows. And if you don't have any protection on that, it's going to be harder and harder to get back to your high watermarks and get back to the balances where the market doesn't have to make all-time highs when I get paid on higher highs. If you are a buy and hold investor, you need this market to get back to all-time highs for you to say, well, now I'm break even. Because a lot of traders, unfortunately, they're invested too heavy and they don't have any buying power and they over leverage. And when the market's down 10%, they're down usually 10 to 20%. And then the market goes back to all-time highs and they're maybe break even. So it's like that's the trouble that a lot of traders deal with. So, I'm not looking to take some insane amount of money to say, look, I'm going to teach you this masterclass series. I'm looking at this is about the same cost as a 1-month insurance payment. Okay. So 10% to the downside, paying me triple digits on 3 wins. That's over 300% gains for that particular stab on MES. And I had hedges on Qs and SPY and ES as well. And more alerts coming and more time to do it. August, September, December, those are the windows I'm looking at for this Crash Insurance Masterclass on Thursday. So what would I charge? Whatever I want, but I think I'm just going to make it really easy. I still have spots available right here. I have spots available for 250 people. Okay. They are going fast. They're selling out. Why? Because I'm only charging $197 for this entire video or this entire masterclass series where I'm doing it live with everybody. $197 about the cost of a insurance payout of some sort for everything you see. So live sessions together, strategy guide. We'll talk through tariffs. We'll trade live. $197. All right. So if this helps me protect my portfolio, helps me get further ahead if the market ultimately does find that low and gets back to those highs, that's good. I know that when the markets are down, I've got hedges working in my favor that helps me offset some of the pain, which means I can sleep easy. My days of trading 24-hour markets like FOREX, trading futures, they're fine, but it's not my favorite. I don't like to know that my stops or my levels are getting disrupted. Flash crashes happen when nobody's watching during holidays, during summers and August. It's like I just want to trade options on most of what I do with a defined risk. Makes my job easy. Price goes up, I make money. Price goes down, I'm protected. Price goes sideways, I generate income. It doesn't have to be complicated, but this insurance stuff is important to protect your overall trends, right? I want to make money every single year. If the market goes down, how am I going to make money? Well, I have insurance protection. I have these crash insurance masterclass protections, right? These hedges. So if I can survive and then still generate my income as IV gets bigger when the market is scared and fearful, that's Warren Buffett's famous saying, buy when others are fearful, right? So sell when people are greedy, buy when others are fearful. This market was down 10%. I was selling premium, selling premium, selling premium. Took a lot of profits over these last couple weeks when the market was back up. I'll do the same thing again. Okay. All right. So I'm going fast, Carla. I know it's going to be recorded. You can see the recording afterwards. ProsperityPub.com/insurance. That is the website. I'll post it right here. So let me see if I can just drag this. Or okay, two ways to get there. So www.prosperitypub.com/insurance, where you give us a call. This is the direct line to our customer service team. 904-706-3537. And you can secure one of these 250 spots. The price right now at $197. Once we cross 250 for this first cohort, the price is going up at least $100. So right now, $197. We cross over 250 people, we're going up to probably $297. We get another 50 to 100, probably another $100. So at most, this could be like a $497 to $995 class. I really don't want to charge that much. It's up to the publisher. Depends on how many students I have in it. But I do know right now, locking it in for $197 is not that bad. Plus, we have the kickoff class this Thursday, so time is of the essence. You want to jump into that class with me on Thursday. I want everyone that joins me to have the best experience possible. I want everyone to understand why I do this. It's not like I want to sacrifice a 0.25% risk if I think the market's not going to go down. But I'm willing to sacrifice it because that 0.25% that could pay me 2, 3, 4, 5% in profits, it is way worth it, right? Because I don't have to be right very often, but it's enough to say, look, the market is probably not going to drop 50% in a straight line. It's going to go down 10 and up 8 and down 10 again and up 8 again, or down 15 and then up 20. And then who knows, right? But it rarely happens in a straight line. The concern that I have in these markets as we move forward is these cycles are happening so fast and so much faster. And these leverage instruments on top of everything we trade is so big that's why we're seeing Nvidia down 20+%. That's why we're seeing, MicroStrategy and Bitcoin and all these leverage ETFs on top of one stock. It's layers upon layers of leverage. And that's what this also is showing, right? I mean, this is why you start to read, the market's down 10%. Everyone's panicking. All the sentiment is terrible. Well, the reason why is because everyone was leveraged on Mag 7. So Mag 7's down about 20%. But if it was a majority of your portfolio that's leveraged, you could be down 30, 40%. So what do you think's hit the panic button? All of the excessive leveraged trades on what's rotating. And that's why sentiment's like the worst reading we had since the bear market. And it was like, this market's down 5%. And we're talking about extremes in AAII sentiment that haven't been seen since 2022's legitimate bear market. It's kind of nuts. But that's the market. Like, we have faster cycles, we have more, we have bigger booms and bigger busts, and stuff happens a lot faster. So anyway, I want you to have the best experience possible. I know if we get over 250 people, I might have to spread out the times that I do it. I want to make sure I can answer everyone's question, but that's what I'm saying. 197 to lock it in, you get 250 chances. And these are filling up fast. I did my first webinar on this series on Saturday, and I want to say there's possibly maybe 50 spots left. So it is first come, first serve, and then the price goes up. So if you get in late, maybe you're paying $297, but give us a call or work with our team. We can help you out. So once you claim your spot, we'll be trading on. We'll be talking through core strategy on Thursday. We'll be looking to trade every Thursday this month. To me, this is the best way to stay ahead of the markets. I don't know what's going to happen. This is a giant question mark. Are you freaking serious? Hang on a second. I got to check one thing. Son of a biscuit. Well, it doesn't really. Never mind. It doesn't matter. I was gonna say it came close, but it wasn't my break even. It doesn't matter. Sorry, I was just curious on the NDX trade today. I still lost, but I saved myself about 10 grand. It is what it is. Okay. Live trading. Look, you can learn a lot by me showing you, telling you, but you learn a lot more by doing it. So if you want to learn how to hedge, doesn't have to be a crazy risk. It's very calculated. It's very tactical. I almost set these trades up and I forget about them. Obviously, I set lots of chart alarms and the market's going down. I'm paying attention to my hedges. It's that simple. If I risk $500 and I'm up $2,500, I might take some profit on that one hedge. If I'm risking $500 and I'm up $3,000, $4,000, $5,000, I'm probably taking profit on the hedge. That's the type of asymmetry I'm looking for. Okay, but I want my account to be positive if we have these nasty downturns. So if you claim one of those 250 spots, there will be a bonus page that I don't want you to close it. I just want you to think about this. I have a lot of traders that are in my daily profit play service that trade with me every single day. Okay. So this 197 insurance for this crash insurance masterclass can be applied and discounted to the service that I run every single day, Monday through Friday. Okay, so if you claim one of the 250 spots for $197, there would be an upgrade if interested to trade with me every single day with a market neutral strategy, which means today the market gapped 1+% lower, went all the way back to fill the gap on the day. And where did I get my trades this morning? We closed 2 for 2. We are now. I need to update this. Let me go into this little screenshot here. I think I have it in my. Give me 1 second. Yep. So we are 37 for 39 in the month of March. 37 for 39 winners with this strategy that you have an opportunity. If you want to trade with me every single day, we are 37 for 39 through the month of March, which obviously was a crazy, awful month for most traders. So if you want to join me and learn that strategy, you can get that 197 applied towards that service and get a nice little discount. Okay. So you can trade with me almost every day of the year with alerts, live trades, live sessions every single day. Okay, that's my daily profit play alerts program. We're typically trying to make about 50 to 100 bucks a day with a very calculated risk. It doesn't matter what the broader market is doing. I'm able to trade and generate profit almost every single day because market makers do this same style of strategy 50 plus years running and they crush it, right? So anyway, that's the deal. So you can get your entire crash insurance masterclass series applied towards the daily profit play. You'll see that in the bonus page if you click on it and secure one of those 250 spots, right? So you're basically getting that crash insurance masterclass for free as you jump into that daily profit play if you want to jump into that bonus. Okay, this might be one of my last slides. I got maybe a couple extra questions here, but prosperitypub.com/insurance or give us a call. You can also, if you're interested, support at prosperitypub.com. You can email us or give us a call. Best way to get a hold and talk to a person, 904 706-3537. Class kicks off 4 p.m. Eastern Time on Thursday, April 3rd. That will be fresh off of Donald Trump's tariff talk, Liberation Day, whatever the hell that looks like. We'll find out. Okay. Take away this from the briefing. Nobody enjoys buying insurance, myself included. I hate paying for it. I feel like it does nothing, right? I drive once a week with my car. Do you think I want insurance for $200 a month to do that? No, but I do it, right? But I will, with pleasure, buy insurance on my trading account, which is one of my biggest assets that I have to my name. Okay. So that's the way I look at it. This is what I try to make as much money as I can every single year. Why would I not be willing to protect the downside when these inevitably happen? Okay. And it's a tiny little cost. It's very calculated. And, if I'm paying $100, $200, $500, whatever I craft the strategy to be, it's very high reward to risk. It's very asymmetric. And inevitably, these markets can be timed. I'd say, I'm pretty good at what I do. I'd say within a 3 to 6 month window, I can get a hedge correct. So I don't want to be, I don't have to be perfectly accurate on like, hey, the market's going to fall this day. Well, obviously that's difficult, right? The market's going to fall exactly this amount. That's difficult. But if I get a window right and I get the lion's share of the protection, awesome. Okay. But that insurance pays, 3, 4, 5x and take that to the bank, right? Protect your portfolio. You can handle the drawdowns. You can build your accounts back up faster because you're protected a lot of that portfolio risk. All right, let me ask you some of these questions. This is a repeat here. We've got insurance on our car, insurance on our house, insurance on our possessions, insurance on our health, and we're forced to pay it. We kind of do it begrudgingly, but why would you not do it on something that's guaranteed to happen? The markets are going to fall at some point. Sometimes little, sometimes a lot. I certainly want to be protected against the lot. A little 2 to 3% dip, it's fine, but I'm protecting against like the 5s, the 10s, the 15s, the 20s, right? If we get worse than that, yeah, you bet you want to be protected. So, like I said, if you're guaranteed to get into a minor car crash, your house is going to catch on fire, you'd have the best insurance possible. So why not do yourself a favor and grab the 197 to get this insurance masterclass? Okay, it's very straightforward. So you take the first step, click on the link. I posted in the sessions here, prosperitypub.com/insurance, or give us a call, talk to a team member right away. Let's do some FAQs. How much money do I need to place these trades? We'll talk about a masterclass on Thursday. This can fit virtually any account size. I would say traders that even have, as little as like $2,500, $5,000. It might be a little bit higher risk, but the premise is the same. We can take these for as little as sometimes $50, $100, and you can still have that, $100 risk pay hundreds of dollars, maybe even thousands of dollars of protection. So that being said, there's a lot of ways to craft the strategies. Okay. Do I need an option? Do I need to be an options expert? Of course not, right? I will teach you everything about the core strategies, all the different ways to trade and protect your portfolio, individual stocks if you want to, the entire portfolio if you want to. We'll talk about it on live classes. Classes this Thursday at 4 p.m. Eastern time, then every other Thursday, live trading at 2 p.m. Can't make a session. It's recorded. It's posted in your classroom. Trade alerts. If I take something that's not together, if we're in a class together and I don't take a trade, or I'm trading, during my normal routine, opening bell, closing bell, and I place a trade that is hedging for this month of April, I will post it for a blanket message to all members. So there won't be anything that I do this month that you won't have access to. Okay. But the plan is I want to be looking to build these trades together in class. Am I worried about the downside this year? Yes, I really am. Now, I don't know if the market's going to continue to fall straight. I think that there really is this like bifurcated market where it's like, what does government want? What does the Fed want? What does the economy need? And what does the global economy need? And we are like all potentially diverging into like different paths. So the government wants to show, even though it's very difficult to do this, to show that we're trying to run, lesser deficits, which is mathematically almost impossible because the U.S. operates at about 108% debt deficit anyway, just by having the essentials. Medicare, Medicaid, interest payments, and military is 108% of our GDP. We're already at a deficit with those things that are like non-negotiable, but it's everything else that could be trimmed. On top of that, tax receipts and revenue, all these things could continue to go up. Tax receipts for the last 10 years have gone up like 60+%, but we've increased by 90% spending. So we just dig this deeper hole, and this is what this government is talking about, which is this needs to be corrected in some capacity, trying to correct it. Okay. So I believe that the low is not necessarily in this Fed put, this Trump put. Where is it at? It's not 10%. Okay. If the Fed is going to step in with any type of emergency level, it could be 20, 25, 30% off the all-time highs. That's when things get scary. But that's when this crash insurance pays very, very, very well. Okay. All right. So what I want is I don't want to stress. I try to stay objective, trade the market as is. I have winners, I have losers, I grind, I actively trade. I don't want to get stressed, right? Stress is a killer. I want to trade. I accept the challenge. So I know that if the market's going down, I've got something working for me. Make sense? All right. There we go. Last slide here. ProsperityPub.com/insurance, or call us directly 904-706-3537. That's all I have for today. Okay. So I hope to see you on class on Thursday at 4 p.m. Eastern time. If you also are upgrading from the 197, claiming your spot for those 250 members, if you're upgrading to the daily profit play, then you can join me in class tomorrow morning, which we are live around 9 a.m. every single day, right before the open, and we're looking to trade shortly after the open. Right. So, and that's another thing. Here's my one little bonus for today. I'm going to say, if you come into my daily profit play session tomorrow, you can type in new for DPP. If you're coming into my class tomorrow morning at 9 a.m. for the daily profit play, type in new for DPP. Actually, you know what? Do this instead. Go new. Actually, whatever, dude. Just do this. I'll keep it simple. New for DPP. I did this last week and I had some other secret phrases, but I just want to know, like, you're coming into the class new. I had some new traders that spoke up later in today's session. So I've got a way to get you up to speed, get you caught up right away with that daily strategy. We have been grinding like crazy for the last month or so, and we've been killing it. 35 to 37 winners. Feels pretty darn good. Okay. All right. Question pops up here. I have 12% of my account in cash right now. I don't have any hedges right now. Should I use this to buy more dips? Should I use it to hedge? I mean, that's me. You're asking me, like, what's the best way to make it's like right now, I don't know what the best way and what the best direction is. I mean, I'm taking bites right here, but I'm mostly selling a lot of premium because I don't believe that the market is really going to give us any clear direction. I think we're a long ways from all-time highs, and we might chop around before we have like a nasty flush lower. My bigger concern, though, is to the downside. Like, full transparency, my bigger concern is that this market just flushes lower. And here's an example. Okay, here's an example. I will go to one chart and I'll let you go. This is the S&P in 1998. That's the closest thing I could find historically to what we're potentially dealing with right now. Okay, let me go back to 1998. And this was during the roaring 90s when the markets were ripping and everyone was happy and super stoked about the 90s decade because everyone was killing it. Middle class is up. Bill Clinton's arguably like the most passive president, but had a great economy, so everyone liked him. Obviously, he did some other things in the White House that not a lot of presidents are doing. But here's my point. This market since 90s, look at this decade. I mean, 1994. This is insane, man. From 1991, 1990, straight up, pause, straight up. It's this. Look at this 1998 turn. From 1998, this is July to October of the same year, minus 22% in July, August, September, October, 4 months. In 4 months, this market purged 22%. But look what it did. Rallied, pullback, rallied. And by the end of the year, we're back up to all-time highs, 28% to the upside, and continue to proceed higher, right? So this is the type of environment that I could see happening as policies are shifting and regimes are shifting. I could see the market having this type of crash to then Trump gets the tax breaks he's looking for. You've got bipartisan support to save and help the economy. And all of a sudden we have a V-bottom in some degree and the market's back up to all-time highs. But it's not without the pain in order to get that. So if we get this, I want my insurance to pay a lot of money and I want to be able to actively trade through it. And when we get back to these highs, I want to be way above that 20% correction, right? I want to be making 30, 40, 50% to the upside as it gets back to these highs because we can still participate. We still have buying power. We still have profits. So long story short is I am more worried about the downside. That's the easier thing to protect. If I'm allocating 0.25% a quarter, 0.25% for half a year, 0.25% for a year, so you're telling me you got 12%, I would gladly sacrifice 0.25 to 0.5% of my account to be protected out to the end of the year. That's not a lot of risk, and then the rest is you trade through it. You use the cash you have to trade through it. But if you're already down 10, 11%, the market's down 10, 11%, which means you never have protection in the first place. You're probably trading too big, and you're certainly overinvested. Like, that's a lot of investment where you have no wiggle room if the market's going against you. That just makes you less agile. So anyway, just my thoughts. Okay, that being said, I'll let you go. Any questions? I hope to see you in class on Tuesday if you're getting in the bonus section here. So if you sign up for the 197 Crash Insurance Masterclass and you want to get in my daily profit play as a bonus, you can get that all through checkout. Let me know you're in class new tomorrow. That'll be a 9 a.m. session. And then Thursday at 4 p.m. Eastern Time will be this Crash Insurance Masterclass. Okay, classroom's already open. You can jump in there, watch the welcome video, PDF and Liberation Day playbook, and all the stuff we'll talk about will be on Thursday. Okay, NASDAQ got pumped so much because it's been the worst. It's been beat up the worst. Yep, it was beat up the worst. So, all right, that's it for me. Have a great rest of the day. I hope to see you all in class Thursday at the very least for securing that one of your 250 spots or some of those upgrades to get into that daily profit play, which we have been killing it this year with a lot of wins, even through this crazy market, which is fun. So, all right, thanks everybody. Have a good rest of the day. See you soon. Bye.